Elaine is an academic, she's a professor, and I sometimes get a bit grumpy about academics when things get too theoretical. What I love about Elaine is that she's evidence-based, she's an academic, but she's extremely pragmatic. She spends time in the front line, and she knows the reality and the day-to-day of the things that she's talking about. She loves a good debate, even with someone with laryngitis when she's had a 4-day trip. She's passionate about the subject of consumer finance. She cares about the people she's talking about, and she's got a global perspective. And when you bring all that together, that is mind-numbingly fantastic. And I'm going to step off the stage and hand over to Elaine.
Thank you, Diane. How on earth can I ever live up to that? Anyway, thank you all very much for inviting me. It's really lovely to be back in New Zealand. Even if I've spent 60 hours getting here, it really is lovely. It's very nice to be back. And I look forward to another couple of weeks here as well with my family. We hear a lot about financial literacy, financial capability. People often use the words interchangeably. Are they the same thing? I believe fundamentally they're not. And both internationally and here in New Zealand, we're seeing a subtle but I think very important change from an emphasis on financial literacy to one on financial capability. And that, I believe, is much, much more than semantic. And I hope by the end of today, you would agree with me. I'd like to start by just outlining what I think is the traditional, what I call traditional financial literacy approach. It's basically a simple concept. People can be financially literate or not. And so there are attempts to measure the overall levels of financial literacy. It's based primarily on knowledge. More recently, skills and attitudes have begun to be added in response to some of the critics that will mention shortly. It's generally normative, and by that I mean it's what people, usually self-styled experts, believe we ought to know, we ought to be able to do, and we ought to think. It often, in these surveys, includes calculations of things like compound interest and calculating the effects of inflation, which to my mind is kind of irrelevant to most people's everyday lives. And also I would question, what are you measuring if you're measuring someone's ability to calculate compound interest? Is it their mathematical ability, or is it something more? I think the financial literacy approach is also based on a belief that the required knowledge and skills can be taught. And in doing so, we can achieve people who are fully financially literate. The focus is firmly on the individual. It's about changing and molding that individual, training them to have the right skills, the right attitudes, and it takes scant notice of culture and environmental factors. As a consequence, financial literacy programs have a heavy emphasis on workshops, work in schools, and don't go very much beyond that. Maybe I'm doing a disservice to the area, but I think it's beginning to move, and I think growing emphasis is being placed on this wider concept of financial capability. There have been many critiques of the traditional financial literacy approach. They come from particularly psychologists and behavioral economists, some of whom say all of this is a complete waste of time. In fact, there is one woman in the United States, one woman critic of all of this, who has led the clarion call for abandoning the whole thing. It's a complete waste of time. What they will say is there are so many behavioral biases that determine behavior that actually it's beyond teaching. We're talking about things like what the economists, behavioral economists would call status quo bias, the psychologist inertia, which is perhaps a little more understandable. Basically, it says that people need a jolly good shove to do something, whether that be making provision for their old age or whether it's switching bank accounts. People on the whole stick with what they have and need a really good push to get moving. We also know that people take mental shortcuts, and we know that that's particularly the case when choices are complicated. I'll say a little bit more about that when I get further into some of the components of financial capability. But it's really things, people come up with simple rules of thumb that they use in order to create simplicity out of complexity that leads them frequently to make inappropriate decisions. The psychologists and economists would also say that there is a heavy emphasis on instant gratification and therefore prioritizing short-term reward over long-term gain. In other words, people live for today and prioritize buying Jimmy Choo shoes rather than making a pension provision. Finally, they would say that there is a very high level of risk aversion and a tendency to put much more effort into avoiding losses than acquiring gains. And that these things are all so deep-seated that actually, basically, we have to live with them. I don't entirely subscribe to that critique. I think there are things we can do. The other body of criticism has come from consumer policy analysts and from the regulators, who say that the world isn't as simple as either of these two schools of thought, the behavioral economists or the financial literacy proponents would argue. They would say when they look at the surveys of financial literacy that they have inbuilt educational biases in the questions they use. In other words, you need a certain level of education to be able to understand the questions, let alone come up with the right answer. They would also say that there are heavy income biases in questions, so that there is almost a predetermination that poor people will do badly because of the questions that you're asking. They also say that their primary concern is behavior, not knowledge, and that knowledge is not a prerequisite for capable behavior. And then they would say that behavior is influenced by beliefs, by social norms, and by the environment. So where does this take us? I mean, these concerns resulted in a fairly major shift from this notion of financial literacy to financial capability, led initially by the regulator in the United Kingdom, the then Financial Services Authority, and followed by regulators elsewhere, Netherlands, Canada, Ireland, and not by the regulator necessarily, but here too in New Zealand. You are now talking about financial capability. The UK did a lot of seminal work, and I was very much involved in that. Indeed, I was asked by the regulator, could I design them a survey to measure levels of financial capability? We were known for trying to survey impossible things like people who'd had their houses repossessed, finding them was a difficulty, people who defraud the tax authorities, people who earn money on the side and don't declare it. So they asked me, can I measure this thing called financial capability in a mad moment over a glass of wine? I said, sure, we'll give it a good try. How do you define it? And they said, well, that's the problem, you see, we can't define it. So I took a deep breath and I said, okay, so you want me to go out and measure something that you can't define? So we had to start way, way back and begin to define it. And I will tell you how we did that in just a few moments. That work was developed by the World Bank. They had set up a very large program funded by the Russian Federation called the Russian Trust Fund. $10 million went into this program of work, which was develop survey instruments, set up demonstration projects, measure impact, see what works, and actually give people like you a strong evidence base that you could draw on. We worked in 12 countries, from South America, across Africa, the Middle East, and Asia Pacific. And we worked in those countries to measure or define financial capability, measure financial capability, develop demonstration programs, and measure their impact. That work across all those countries and many others has shown that financial capability, unlike financial literacy, is not a single concept that is easily measurable. Indeed, it has a range of different dimensions which are related to one another rather loosely. So you can be good in one dimension and very bad in another. It primarily investigates behavior and is focused not just on personal attributes and characteristics, but also social, cultural, and environmental influences on individuals. The surveys that have been developed from this rather different philosophy are more complex. They're designed to be a diagnostic tool that is merely the starting point and requires further research to follow up and understand the behaviours that it identifies appear to be problematic. It means that the measurement of behaviour actually is quite complicated because whereas with a financial literacy knowledge survey, you can count a number of right answers. I might say actually some of those surveys don't always have unequivocally a single right answer, and so as a consequence you get some bizarre scores. But anyway, measuring behaviour in a meaningful way is rather more difficult. And we've had to draw on the techniques used in measuring levels of morbidity, levels of deprivation, and some of those statistical techniques in order to do it. But it can be done. The work also shows that you can be incapable whether you're rich or poor, which came as a bit of a revelation at that time. But it's without any doubt whatsoever that the poorer you are, the more serious the consequences can be of your lack of capability. If you're rich and you're totally unable to curb your spending, with luck you've got enough money that never becomes a problem. If you're very poor and you can't curb your spending, then that spells disaster for you and your family. And because financial capability is a very much wider concept than financial literacy, it actually requires, indeed, it opens up a whole Pandora's box of different innovative techniques for tackling low capability. At a personal level, it, of course, means the traditional financial literacy approaches, but it also means learning by doing. It can mean one-to-one counselling. It can even mean prompts through text messages, as I'll demonstrate as I discuss some of the specific areas. It requires tools that can work at some of the cultural biases that influence our behaviour. That can involve edutainment. By that I mean soap operas, storylines in soap operas. It can involve interactive computer games. It can involve comic books, stories in comic books. Social marketing, harnessing the tools that Diane used in her previous existence and can now use for social good rather than commercial gain. And it can involve things like auto-enrollment, such as you have with KiwiSaver. At the environmental level, it opens up the whole question about where does information to enable people to make choices end, and where does consumer protection have to start. So it's a much more all-embracing concept than financial literacy. But I think if we're going to see truly financial fit populations, then we need this broader approach. So I've talked a lot about financial capability without actually telling you what I think it is, or rather what ordinary, everyday people think it is. Because what we did in both the UK and Ireland, and then later with the Russian Trust Fund, as I say, in countries across 4 continents, from high income UK on the one hand to very low income Papua New Guinea at the other end, what we did was use what is known as the Vox Populi approach. In other words, focus groups. We had groups of 12 people in a room. They were segregated, of course, according to age and income. So we had low-income young people right through to higher-income young people, and of course, all relative income levels in each country. So we had about 8 to 9 groups in each country. Some did rather more, and particularly in the Russian Trust Fund. And we sat them down and we just said, if I say Diane's really incapable financially, tell me about it. Tell me more about it. Let's discuss Diane. What sort of things does she do, think, believe? No, you tell me. So we had this long discussion about Diane. We always started with the incapable because people can latch onto that most easily. And then we said, but Miles over here is really, really capable. Now tell me about him. How does he differ from Diane? So we had these really interesting discussions. I was told that actually in P&G people had very minimal education and would find this difficult, and so we had in reserve a whole load of prompts. But don't you believe a word of it. They could tell us very easily what an incapable person looked like in their experience, because that's what we wanted to know. We want to know what did they think were the most important things to be addressed. Well, we did the UK and Irish work first, and then after that moved on to the World Bank work. And after we had done all the focus groups, and we did 120 on this World Bank study, so it's a huge, huge thing. I had the benefit of seeing all the results. But we got all these teams together in Paris, and they were all to make their slide presentations based on what is a capable person and what is an incapable one. And the results were truly amazing. The representative from P&G stood up and started speaking, and had the young woman from Uruguay sitting next to me, and she said, "He's stolen my slides." Because one after the other, they said exactly the same thing. And that all entirely resonated with what people had told us in the UK. And even though I thought there would be some similarity, I was amazed at the extent to which different people at different incomes and different cultures would identify the same basic attributes of a capable or incapable person. So what were they? I'll just tell you the broad areas, and then we'll go into each of them in more detail. They said it was to do with day-to-day money management. It was about planning and keeping track of your spending. It was about living within your means. It was about planning for future needs, whether they were expected or unexpected. It was about choosing and using financial products where they're available appropriately, and it was about informed decision-making. Now, clearly, the balance of importance of these different factors varied. So the poorer a country is, or the poorer a person is, the greater the emphasis is on day-to-day money management. And in countries or communities where financial services infrastructure and provision is fairly limited, the less importance on choosing products. But all of these elements were apparent in every country. So I want to draw on these research findings, and I want to discuss a little bit about what each of these areas means, each of these subject areas means, what they include, how capable people generally are, and some subtle differences between different communities, and then what sort of interventions seem to work best. So let's start with planning and keeping track of spending. This, we were told, was about both making and keeping to a fairly detailed plan for your day-to-day spending. But that didn't have to be written, and because, of course, many of these people were not literate, it was perfectly adequate to keep a very clear idea in your head. Yet a lot of the financial literacy training was all about written budgets. And of course, if you're not literate, then that's absolutely impossible. Monitoring spending. It was about knowing how much you spent and how much, more particularly, how much you've got left to spend and whether that's enough for all the things you still have to pay out. Pretty self-evident stuff, really. But they were saying one after the other that this is really important. What was very interesting is that in all the surveys, most people actually do this really quite well. It's one of the skills that most of us have, unlike other areas of financial capability. And yet most of our interventions to date have been around budgeting. And they have been focused on the whole population, whereas what all the surveys show is there is a minority of people that are really quite incapable. We can, of course, teach these skills, but we do need to bear in mind two important points. And these are the reasons why many people demonstrate low capability. Some people are actually just plain disorganized, not just with their finances, but with everything. Try as they may, they lead disorganized lives, from the minute they wake up to the minute they fall asleep. Others are actually quite well organized and usually manage incredibly well, but they've had a drop in income for some reason, job loss, ill health, or maybe just a drop in income, as the poor souls in Greece are suffering from at the moment. And what people typically do in these circumstances is start to juggle, to try and robbing Peter to pay Paul, juggling in an attempt to achieve the impossible, which is to pay commitments that were manageable on a higher income with an income that's inadequate. So really one needs to start young, As you saw in the clip earlier there from one of the workshops yesterday, there's been a really good program funded under the Russian Trust Fund in Brazilian schools, which is a shining example of how you can work with children and their parents, not through traditional classroom techniques, but through some really, really imaginative materials developed by the educational psychologists. So you can, if you start young, begin to mold some of these behaviors. I think we need, embedded within debt counselling, one-to-one assistance to help those people who have begun juggling in response to a drop in income to take charge of the finances once again and get things back onto an even keel. But I would say the evidence that we gathered through the various programs that were developed and where the impact was measured is the effects of one-off workshops are incredibly limited. In fact, in some cases, they have no effect whatsoever. So I think this is an area that's amenable to teaching. We do need to start young, but we do need to build longer-term interventions than the short one-off. The work with the Russian Trust Fund showed that up to 20 hours, you continue to have an increased impact. Beyond that, it plateaus. So the second component of day-to-day living, day-to-day money management, is living within your means. And this, we were told, was about restraining your spending, knowing when to rein spending in, and not borrowing to make ends meet. It was about prioritising spending on essentials and not impulse buying. So buying the essentials first and knowing when to say no to your kids, to yourself, and actually to somebody trying to sell you something. Again, we found that most people actually do quite well. A minority don't, either because they're poor and haven't got enough money to live on in the first place, and no amount of education or intervention will ever change that basic fact. They are just poor and they can't make ends meet. And of course, in some of these countries, people were incredibly poor and were living day to day with inadequate incomes even to feed their families. Or we know that people fail to live within their means because they've got these deep-seated behavioural biases that the psychologists and behavioural economists were telling us about that mean that they simply can't curb their spending. And that's often reinforced by cultural factors. So we can see quite significant cultural differences between countries. In the UK and the United States, we live in a consumer credit culture that fuels consumer spending. You don't have to go very far from the UK to Germany, where you see that that is not the fact, that actually credit use is frowned on, credit is referred to as debt, and debt is Schuld, and that same word means shame. The word for debt and shame is identical in many Germanic languages. So even within Europe, you can see some major cultural differences. There are also cultural and ethnic differences between groups in our society. So we know in the UK that Bangladeshi and Pakistani women do not play any role whatsoever in day-to-day money management other than small amounts of spending at the village shop, but it's the man who manages the money and determines how much money is available for what. When a Bangladeshi woman becomes divorced, she's left alone and she struggles. She really struggles to get control of the family finances. So we know that there are differences within our societies. We also know that there are generational differences. We did some work on attitudes to credit in the UK and found actually recently some fundamental differences between young people under 25 and people aged over 50 in their approaches to credit. Young people believed that actually credit was just a means to an end, and that they were under huge pressures to keep up with everybody else, to lead this consumer lifestyle, to spend on things that they knew they didn't really need. They believed that if they were falling, well, they would recognize that they were getting into difficulty when their creditors told them, whereas the older generation believed that it was for you to check when your credit card limit was getting too high. Young people waited till they got a letter from their creditors. And whereas the older people believed that it was for you to rein in your spending when it all got out of hand. The young people were saying, much to my amazement, that they thought that you should go into bankruptcy, or we have something that stops just short of bankruptcy, which basically locks down your finances for 5 years, but then means all your debts are written off. And they said that was a price worth paying. So some fairly fundamental differences there across the generations. And there are gender differences. Back to the Pakistani-Bangladeshi situation again in UK, the experiences of men are very different from women. Now, I'm sure most of that translates quite neatly into the New Zealand context too. So the interventions need to reflect this. Obviously, increases in income are more appropriate for the poor, but then we shouldn't be trying to teach them how to live in poverty. But what are the other things we need to do? On a personal level, dealing with personal things, personal biases, we need one-to-one counselling, and of course debt counselling above all else. Phone apps work very well in prompting people to make credit payments or to save if they're in a savings plan. At a cultural level, we know that edutainment works very well. In South Africa, there was a very good soap opera called Scandal that ran for 6 months. The storyline was all about a woman who over-borrowed, spent too much, over-borrowed, got into serious difficulty, was not paying household bills, took some money. She was treasurer of a local club. She took that money to pay off her credit card, and then the whole edifice fell down, had to tell her husband, and had to find debt counselling. And that was the main female character in this soap opera, was the person who was getting into difficulty, and one with whom many, many women identified. They've yet to do something for men, I might say, but anyway, for the women, there was a big surge of calls to debt counselling, and this really did have a very, very large effect. You can use computer games. We worked on developing some very innovative games with gamers, people who develop games. I wouldn't dream of trying to develop them, but it was using games to tackle a whole set of different social issues, and one of them was low financial capability amongst young people. And it was about scoring, it was about atavars, and they were identifying with this person and learning by playing the game without even being aware they were learning. You can do it through comic books where they're important. Some cultures they are, some African cultures they are. Japan, they're very important, and that we've again tested them in an African context. And they work well when everybody has them, where they're widely read, because then you get reinforcing messages. If we move now on to planning for future needs, here we're talking about things like a large unexpected bill, or expense, a large drop in income, a major expense that you know is coming up, a big party, a big wedding maybe, or your retirement perhaps, or maybe less so in some countries. It would be more just providing for your old age when you can no longer work. And we know that populations are very much less capable in these areas. Money management they do well, this they do much less well. And people fail to plan because frequently they're, again, too poor and don't have the means to do it. But then we have a whole lot of other factors which influence whether or not people plan. Some people lack the discipline to save at all. Others live today and don't worry too much about tomorrow. They're very much hedonists and say, literally, I do live for today. Or inertia is also equally important. So we have personal, we have cultural, and we have some environmental issues there. And again, the interventions need to reflect these rather fundamental differences. So we need, I think, to inculcate the saving habit from a very young age in children, and all the work that I have done has shown that a rainy day saver, somebody who always puts money aside, is somebody who started saving as early as 5. And you can't start early enough. You need to learn that instant gratification is not a good idea. And you do need to start very, very young. Clearly, environmental issues are also important. We need safety net provision for people who are too poor to make their own. Maybe that's self-evident, but I think we should be aware of it. We shouldn't assume that education or any other intervention other than supporting people is the answer. But the design of accounts can also play a part. We had it for a short while in the UK. Unfortunately, we had a change in government and it went, but a rather lovely match savings scheme called the Saving Gateway, which I was lucky enough to help develop and to evaluate. And the very design of that account, which was aimed at people on low incomes, it was designed to ensure that people saved regularly and didn't draw on their savings. So it was a regular £25 a month maximum. It ran for 18 months. You got a matching on the maximum amount you ever had in the account, which was equivalent to 15 months savings. So you had 3 months where you could have a hiccup and not make any deposits. But if you drew the money out, you couldn't pay it back in. So you wouldn't get as much in matching if you started drawing your money out over the 18 months. We discovered that even very poor people saved regularly and saved the maximum amount. And the savings at the end of it was not hypothecated like most match savings schemes. They didn't have to spend it on specific nominated areas such as education or housing or business startups, which are the usual. We persuaded the UK government to be libertarian, and so people were free to choose what they did with the money. And most of them chose to keep it in savings. And most of them chose to carry on saving, saying it had become addictive. They'd got used to putting aside that money. And the word addictive, addiction, is something that people regularly use about savings when they become converted. But actually, most of the factors that will influence and change behaviour in this area are cultural ones. So pension auto-enrolment, such as KiwiSaver, and we have an equivalent in the UK, modelled in part on KiwiSaver, that works far better than education in driving up levels of provision. That's been tested in the United States, and it has 10 times, at least 10 times the effect, sometimes even bigger. Social marketing has a role to play, and by that I mean marketing for social purposes rather than commercial ones. The insurance industry knows all too well that insurance is sold, it's not bought. And that's something we should bear in mind. Persuading people to make provision, you do need to persuade them they won't do it automatically because of inertia and all sorts of other reasons. Things like making a public commitment can play a big part, and so we can learn from techniques in other areas. Slimming is a very good one where women make, usually women, some men do go, my niece tells me, having just been through such a program, but you make a public statement about what you want to achieve and then you discuss it each week. A public commitment to achieve something, to save money, does have a big effect because people feel once they've articulated, they should do it. So on to the third area, which is choosing products. Not as important in some countries as in others, but I would argue very important in a country like New Zealand. And indeed, it's frequently overlooked by financial capability and certainly financial literacy surveys. But when it is included, what we find is that people universally are very, very bad at it. Almost all the scores are skewed right towards the incapable end of the scale, so for your end, right towards that end, with only a tail of capable people. And in general, consumers don't gather information on more than one product. Let's say they're going to get a mortgage. They buy on price alone. They buy the cheapest, which isn't always the best. They rely heavily on sales staff. They don't know the key features of products they hold. Very basic ones like what is the interest rate on your credit card, they can't tell us when we ask them. And they don't switch products even when they've got something which is really bad. When they've got a savings account where the interest rate has been gradually eroded over the years and there's a new one, not in the current climate in UK, but people would have accounts paying 0.5% interest when they could get one paying 5%. I mean, if only at the moment, but in the past that's certainly been the case. The complexity of the marketplace leads firstly to inertia, because we do live in a very, very complicated financial services marketplace. And people rely on simple rules of thumb. We had a very nice scheme when every child at birth was given an endowment by our government, and parents received this money and they could deposit it in an account. If they didn't by the end of 12 months, then the government automatically placed it in an account for them. When we interviewed parents in a survey before the scheme, they all said, the vast majority, 99% said, I will make the decision about where this money is invested. After the accounts were introduced, 25% of them failed to do so. And we tried to explore why this was, and we discovered that people were just paralyzed. In fact, one person described it as paralysis by analysis. The more I look at what's out there, the more paralyzed I become. So they just used simple rules of thumb. They said, well, I'll go to my bank and I'll just take whatever they offer. And the more sophisticated ones said, I'll look for an ethical investment, because there aren't many of those, and then I've only got 3 or 4 to choose from. So people use these very simple rules that they apply in order to make a complex decision a simple one. And more particularly, what we found was that there was very little difference in the decision-making process, or what people did, between those who decided early and those who decided late. It was just that some of them were decisive and just, oh, to hell with it, I'll just go down to my bank, and took that decision early on. Others took a long time to reach that point. That was the only difference. Everybody was really rather confused by all of this. We know that consumers place far too much trust in financial service provider staff. They treat salesmen as if they were impartial advisors and follow their advice. And we only have to look at the payment protection insurance mis-selling scandal in the UK to see the consequences of that. One bank, Lloyds TSB, has paid out 11 billion, and that's with a B, pounds in compensation to its customers for mis-selling of payment protection insurance. Risk aversion leads to poor decision-making and also to over-insurance. We know that some people insure 4 and 5 times over for an identical risk because they're so risk-averse. So what sort of interventions do we require? Well, obviously we need independent information sources such as comparison tables to enable people to make sense of this jungle out there of products. But because low capability is so widespread and influenced by fairly deep-seated behavioral biases, I think the answer has to lie in consumer protection and robust regulatory supervision. Both of those are, I think, essential. Other forms of intervention are, at best, I think, secondary. Regulation based on disclosure and caveat emptor, as almost all European legislation these days is, does not deal with the problem. But it is, as I say, the bedrock of so much consumer protection legislation. There is a need for much better regulation of products that are brought to the marketplace, as they do in the Netherlands. They have a regulator there that requires manufacturers of products to demonstrate it's fit for purpose and to identify who it is suitable for and who it isn't, and to promote that information. And we need more proactive supervision of business practices and enforcement to stamp out those that are irresponsible or predatory. And that's the approach that the UK regulator has taken to payday lending. Rather than try and educate people about what to avoid when taking out payday loan, they decided they would act to outlaw some practices. Well, outlaw by, in effect, stopping the business, telling the business to stop that particular practice. Usually rollovers, rather than tell people don't roll a loan over, it's much more effective to tell a lender that is heavily reliant on that for profits, you must stop. We need regulators to engage in horizon scanning. Had the FSA in the UK been much more proactive, it would have identified the payment protection insurance scandal that was coming. And then we need enforcement and regulatory regimes that are based on principles rather than rules. Firms will work around rules. You need principles such as treating customers fairly that you can fall back on. So to move quickly on to the last area, which is informed financial decision making. This is partly personal and partly cultural. It's things like learning from your mistakes, listening to others and learning from theirs, knowing when and how to get more information or advice, and being in tune to things that are likely to impact your own finances. To me, it's not entirely clear whether this is a basic capability and therefore a component of financial capability, or a factor like income, attitudes, and biases that explains capability. I think we need more work to understand that. It's only partially amenable to teaching, and again, things like edutainment, soap operas, and so on have a much bigger effect. So in conclusion, I think there's been a very big shift from financial literacy to financial capability, both internationally and here in New Zealand. And that is much, much more than semantic, much more than just a choice of which word you want to use to describe it. I think it's got some significant and I believe actually really exciting implications. I think it's the start of a process of really understanding consumer behaviour and the personal, the cultural and the environmental factors that impact on it. It provides a much more nuanced understanding of the main problem areas and their causes, so that some areas of low capability, such as over-indebtedness, seriously impact on people, but only a minority of the population. Whereas at the other end, choosing appropriate financial products is so widespread in populations, it's almost the norm. Well, it is the norm. And finally, I think it calls for the opening up of this Pandora's box and choosing from this array of different tools we have at our disposal, whether that be financial education, techniques of nudge, social marketing, or better consumer protection. Above all, I think it means that there is a role for every single person sitting in this room, whoever you may be, whatever organisation you're working in, to play your part in ensuring that New Zealanders become and behave more financially capable. And it requires a body like the Commission to develop a strategy to bring together these many different components in the Pandora's box. Thank you very much indeed, and I look forward to the discussion.
So you could take questions?
If they want questions or discussion, yeah.
Yes, great. So we've got mics along the front. Actually, I might turn this on so I can step away. Is this on, guys, or do I need to turn it on? Yeah. On or off? On. Okay, start again. Oh, look, they're even spotlit. We've got some mics down the front for people with burning questions, and we'll just see if anybody's got anything lurking in mind. Oh, yes, come forward, come hither. That sounds like Mary Home. I'm stepping in so I can see you, Mary. Yes.
I think you need to come down here because we can't see you, let alone hear you.
Yeah,
It's very, very difficult
tell you what,
to
Mary,
see from...
I can repeat it if you want to tell me what it is.
I just want a bit more information about the gender differences in your research findings.
Right, gender differences.
I would have to talk far too long to cover all of those. There are many, and they vary from one society to another. I think you would have to investigate exactly how gendering affects money management in your different communities you have here. As I say, in UK, we know that that some women in ethnic minority communities don't play any role in financial decision making. We know in African communities that the men are very, very likely to drink away all of their money. Indeed, the focus groups told us that an incompetent African man living in a village is a man who spends all his money in the shebeen the day he gets it. He's got nothing left for the rest of the week. And a truly incapable man borrows the money from the shebeen in order to drink it at the beginning of the week. And is constantly living in hock. There are many, many different cultural differences, and I think we need to look at them, otherwise we're missing the point and we won't know who we're addressing in the programs that we set up. So I have to shield my eyes because these lights are stopping us seeing you. I'm happy actually if people want to react to what I've said rather than ask questions, because I'm probably challenging some of you from things that you've always done and suggesting a much wider approach. Sorry, can you come to the mic? It is difficult to hear.
I think in the second slide you put up at the end, we talk about the products and how they need to be regulated, etc. Is the UK regulator moving in the way you would like to see them?
Yes, they are. And the payday lending is a very good example. We were asked to investigate the high-cost credit end, which included payday lending and home lending, home credit, and so on. And our conclusion was that within this industry there was both good and bad. And if government felt that this was payday lending was so pernicious that it shouldn't exist, then they should be brave enough to ban it. If they felt it did have a place in the marketplace, which they did as a form of short-term credit, then they should scrutinise the business models of companies as they issue them with credit licenses. and they have done it. And somebody asked me yesterday about Wonga. Do people know who I mean by Wonga? A big online payday lender in UK. Rose very rapidly, set up by technologists rather than financial services people. Its profits and its customer base was halved after the FCA took that intervention and stopped them in some of their practices. And by that I mean a business model that's predicated on people defaulting, and then you earn most of your profits from default fees rather than lending the money in the first place. So yes, they are moving in that direction, I'm pleased to say. Sorry, I feel stupid standing up like this, but it's very difficult with this light right in my eyes.
I'm just interested in KiwiSaver, which has, it's relatively new to New Zealand. We had a long period where we didn't have compulsory saving, superannuation. And then people are saying, oh, it's great, get into KiwiSaver. And children are going into it. But to what extent does that make them better financial decision makers, like, at 18 or something like that?
It doesn't. It doesn't. It's another way of tackling people's low capability. It's going with their lack of capability. What auto-enrollment does is harness the biases that keep them out to keep them in. You see what I mean? Instead of people not making pension provision because they just never get round to it, you auto-enroll them and use their propensity not to get round to things to stop them opting out. So no, it doesn't change. You can use it as a basis for building greater capability, but as of itself it doesn't. It addresses the incapability. And that's the point I'm trying to make. It isn't all about changing the individual. It is sometimes about changing the environment.
Thank you very much. And can you join me, please, in thanking Professor Elaine Kempson?